Sure,
Remember,
sir.
huh?
Sure, sir. Yeah, I'll inform you before.
Yeah, please, please.
Yes.
So should
Hi,
I
you
start?
might. Yeah, you can start.
Okay. Good evening to ladies and gentlemen gathered over here. We are having a webinar on the topic of derivatives. Wall Street pundits and financial economics have got lots of technical jargon and varying views on derivatives. And in fact, the Federal Reserve Chairman former Federal Reserve Chairman Alan Greenspan had said that by far the most significant event in finance during the past decade has been the extraordinary development and expansion of financial derivatives. The Banking, Financial Services and Insurance Board have always tried to build knowledge base of its stakeholders, and we have organized pertinent topics of varying importance based on capital markets, banking, as well as insurance. So we would like to start with an institute actor.
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय
मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय ॐ शान्ति शान्ति शान्ति
I would like to introduce CMA Chittaranjan Chatterjee. CMA Chittaranjan Chattopadhyay is a fellow member of ICMAI and associate member of the Indian Institute of Banking and Finance, holding qualification from CIPFA as Chartered Public Finance Accountant. He has 38 years of experience of working in commercial bank in different capacities. He has brought out several publications on banking for ICMAI, which include 3 editions on risk-based internal audit of commercial banks, guidance note on concurrent audit of commercial banks, and internal audit of treasury functions of commercial banks. At present, he is Central Council member of ICMI for the second time and chairman of Banking, Financial Services and Insurance Board, as well as IAASB. He is also a member of several committees of ICMAI. He is a director of ICMI RBO as well as director of ICMI MARF. So, sir, I would request you to please say a few words on this topic, sir.
Thank you, Payal. Very good afternoon, rather good evening to you all. I feel really a great pleasure today itself to see that one of the versatile personalities in this, very young in this financial service sectors. I must say that the great future ahead of Dr. Pujitruti Panda is with us. And ladies and gentlemen, really in the past 4 years, there have been lessons learned and wisdom gained. I hope in the coming years also we will continue our efforts in the BFSI sector. At the very outset, I'd like to thank CMA Ushiniji Dalavadi, the president of ICMI, who has given me an opportunity to serve the profession as a in the council by to the Banking, Financial and Insurance Board of the institute. And of course, also I am grateful to my all council colleagues and all the members and students of the institute who have always been been supporting me in this venture. In fact, the BFSI board is organizing this first event for our new council term for the tenure of 2023-27. And we hope to keep the same tempo as done in the previous council with our knowledge disseminations, activities through the webinars, seminars, publications, and courses. We heartily welcome Dr. Pradiptarathi Panda, the Assistant Professor of SSIR NISM, who has been kind enough to grace the occasion to deliver his session despite his busy schedule. The topic for discussion today is derivatives, the future of investment. Ladies and gentlemen, we know that capital markets are the new buzzword, and as plethora of investment instruments have been seen in the form of stocks, mutual funds, currencies, commodities, alternative investments, cryptocurrencies, and so on, many others. SEBI has been a watchdog and a regulator for protection of the investor from misinformation, information asymmetry, market misconduct, and intermediary fraud to provide flexibility and ease of doing business for market participants. The global derivatives and commodities brokerage market is expected to grow from $435.93 billion in 2022 to $469.30 billion in 2023 at a compound annual growth rate, that is CAGR, of 7.7%. The equity derivatives volumes on the National Stock Exchange hit a record 17,350 trillion so far in the fiscal year, trading at 2021 times, trailing financial 23 EPS. In 2022-23, the total turnover in equity derivatives segment increased to 2.2 times the turnover in the previous year. So, ladies and gentlemen, you can understand how it is growing in a very, rather I should say in a rapid manner, and huge opportunities are there. This particular financial derivatives have earned a well-deserved, extremely significant place among all the financial instruments due to innovations which had revolutionized the landscape. Volatility in financial asset price, integration of financial market internationally, sophisticated risk management tools, innovations in financial engineering, and choices at risk management strategies have been driving the growth of financial derivatives at a fast pace. The BFSI board of us strives for knowledge dissemination for the benefit of the members and students. The BFSI board actively synchronizes with various investor-centric institutions, Chamber of Commerce, along with financial sector regulators such as Reserve Bank of India, IRDAI, SEBI, to even PFRDA, to create value for its stakeholders. We had undertaken moves with stellar educational institutions like NISM and NSA Academy Limited for capacity building among our members and promoting financial literacy. We had of online certificate course in integrated technical analysis and advanced derivatives, which was the first advanced level of the investment management course conducted in association with the NISM. And it has got a tremendous response, and many members, many of the participants, they have expressed their highest satisfaction after attending the courses. We had celebrated World Investors Week of IOSCO on October 2022 as a part of stakeholder outreach as per the instructions of SEBI. We have celebrated the investment month for the month of in the month of August 2021, where we have hosted webinars on very relevant topics of investment management, where Caesars of capital markets graced our forum. We have also hosted the Capital Markets Symposium in October 2022, where renowned stock market expert CMA Basant Maheshwari graced the forum at Kolkata and mesmerized the audience with his speech. We are hopeful to launch our new investment management course in association with NSA Academy for the benefit of members, students, and others also. And this sort of activities we are going to hold it in our in this council, and we are very much optimistic that many of our members will get benefit, and many of the those who are the luminaries, those who are the playing a pivotal role in this particular sectors in this stock exchanges, we shall be able to be get them in our forum, and they will be definitely helping us to disseminate knowledge amongst our members and other participants in future. Today, particularly, we are happy to announce that the inauguration of the 3rd annual issue of the BFSI Chronicle, which is the 14th quarterly issue, will be releasing today by our board, and this is the annual volume. As you know, we have included at least 20 articles from the diverse fields of banking, insurance, and financial services. We hope that the issue will give food for thought for various issues of financial world. Your feedback is always welcome for any suggestions and improvement of our activities. Ladies and gentlemen, in the next week, that is 9th September 2022-23, we would be launching the 7th batch of certificate course on treasury and international banking. We request you all to join this capacity building course. And today's program definitely will be giving a great, pleasure for you to learn, unlearn, and relearn on this, derivatives, future of the derivatives. Because when Dr. Panda will be presenting, as you know, he's one of the darling, faculties in our NISM program when he organized. So I'm sure today's session will be very much, enjoyable for you. And I'm again thankful to all my council members, my president, vice president, and all other, those who are well-wishers of BFSI board to always support us for the activities. And I'm sure in future we shall be able to present before you many such events which will have tremendous importance for your professional as well as your life, which would be definitely paving the way for your creation of wealth. With this, I convey my heartfelt thanks to my team, entire team of BFSIB, who has taken this toil to organize this program in this Saturday, which is a holiday for the institute, but they have come and they have joined this course. They have hosted this program with their all, enthusiasm. Thank you all.
Thank you, sir, for that innovating speech, and thank you for releasing the BFSI Chronicle. Now I would like to introduce Dr. Pradeep Rathi Panda. Dr. Pradeep Rathi Panda is an assistant professor at the National Institute of Securities Markets and has a decade of experience in teaching and research in financial markets. Prior to NISM, Dr. Panda was a research scholar at the Indian Institute of Capital Markets. He now holds a Master's in Finance and Control from Berhampur University and MPhil from Financial Markets from Pondicherry Central University, PhD in Financial Markets from the University of Mumbai, and has qualified UGC NET. His PhD thesis, Stock Market Spillovers, Evidence from BRICS Countries, has won the Best Doctoral Thesis Award at the IIF International Conference and Award Summit 2021 organized by the Indian Institute of Finance. He has published more than 30 research papers in index journals like ABDC, ABS, Scopus, Web of Science, and SCL, along with others. Dr. Panda also conducts market stimulation sessions in the Smart Lab for Education Institutions and the reputed cadre of Government of India officers. He has also conducted programs for officers from the Securities Exchange Commission and central bankers from many countries. Sir, Dr. Panda, I would now request you to present your deliberation.
Thank you, ma'am. Thank you, ma'am, for nice introduction. Respected Chittaranjan sir, BFSI chairman, HOD Dibyendu sir, president sir and vice president sir, and all the participants. Good evening to all of you. My task today is to take you through the Indian derivatives markets and what are the futures of investments. So the outline is like introduction to derivatives. Most of you are aware, maybe certain concepts, if you are not aware, we'll also revise those concepts. Then what are different categories of derivatives? Thereafter, SEBI brought out one good report on individual traders' participation in F&O segment. We'll discuss briefly on that. Then what are the roles of ICAI members and NISM on this derivatives market? Thereafter, we'll also look into where we stand as in India in terms of international derivatives markets. What is India's position? I have some disclaimers. Whatever I am going to present is for the academic purpose only. So you don't expect something. I'll recommend you buy this, sell this, or so. I'll only give you the basic structure of market, how hedgers, speculators, and arbitrators are working, and what are the futures behind that. So when we come to this derivatives market, all of us are aware. So derivatives derives value from an underlying assets. That underlying asset can be anything. So before we understand those underlying assets, we should also understand what are the underlying assets available in our market. Basically, if we consider the exchange traded derivatives, we consider currency, commodity, interest rate, and equity. These four types of exchange traded derivatives are available in our market. If we go through the OTC products, forwards and swaps are available. Before we go to discuss that, I will give you two case studies. One is on the hedging aspect when we enter into a future transaction, and another is hedging when we enter to an option transaction. Let us see this. If I'll say Mr. X buys 5,000 shares, so I'll promise later on you will not get this much of text. So just bear with me for 2 slides only. So Mr. X buys 5,000 shares of ABC Limited at 100 rupees per share. Though he is very optimistic about the long-term prospects of ABC Limited, but he is concerned about some of the near-term events that is going to happen on this ABC Limited, and that may impact adversely to the Mr. X position. So what Mr. X will expect if these near-term events are expected to play out in the next 3 months? Therefore, he decided to manage this risk by going short on future contracts of 3 months duration on the same underlying. During this 3 months period, if stock price goes down, then since he is on the short, then but this adverse moment in stock price will give losses on his spot position, but he will get gain in his future position because he has short. When we short, if price comes down and we will buy back again at a lower price, the difference will be our profit. But it may go also in a opposite direction, like if stock price goes up, then his holding will give him good amount of profit in the cash market, but in the future market he will incur losses. So therefore, we should aware about these derivative transactions. Whenever we do hedging, it will not always lead to favorable outcomes, but what it will give us is a certainty of the outcome on the both the sides. Let us take one more example on the call option. Most of you are aware about the options. Let us see, Mr. X wants to buy equity shares of ABC Limited at current market price is 2,000 rupees. But if stock price increases during this period, then he has to buy shares at a higher price. He wants to buy at a later stage. To manage this risk, he decided to buy a call option of 3 months validity on ABC Limited at a strike price of 2,000 by paying a premium of 100 rupees. So that is called as option price. Now, what will happen in case 1, if spot price closes above 2,000 on expiry, suppose say 2,300, then he will exercise his call option as he has a right to buy the equity shares of ABC Limited at the price of 2,000. Now Mr. X will take delivery of shares from the call option writer by paying 2,000 per share. Therefore, his cost of acquisition of ABC Limited share will be 2,100 because 100 rupees he paid as premium. On the other case, if spot price closes below 2,000 on expiry, say 1,700, then he will not exercise his call option as ABC share are available in the spot market at a cheaper rate, he will directly buy those from the spot market and book a loss on his option positions. So that is the amount of premium he has paid. So therefore, his cost of acquisition of ABC Limited is 1800, 1700 in the spot price plus 100 he paid for the taking a position in the call option. In the case 3, if spot price closes at 2000 on expiry, then he may not exercise his call option. Actually, he is indifferent to exercise or not to exercise in this option. He can let his option expire and can directly buy the shares from the spot market at 2000 rupees, because if he will exercise again, transaction cost will be there. We'll be discussing about little bit on the transaction cost. Here, his cost of acquisition of ABC Limited shares will be 2100. In all these scenarios, the call option hedging allowed him to buy the shares of ABC Limited at or below INR 2100. So that is our stock price plus premium. Now, coming back to our financial instruments that are available in our market, we divide broadly them into two categories, equity and debt. But under equity, we can participate in the primary market or secondary market. In debt also, we can participate in the primary market and secondary market. Debt has further two categories. One is long-term debt market and another is short-term debt market. Short-term debt market is money market, those money market instruments. Thereafter, we have one foreign currency or exchange rate market or currency market, we call it. So then we have a commodity market. We participate in currency and commodity markets in terms of derivatives. And we have a category of financial derivative products. Those underlyings are equity and debt. And equity. And then we have interest rate derivatives whose underlyings are debt products. Now, if we look into our Indian derivatives markets, this banyan tree is the mother of Indian derivative market. Still, it is alive. Those who are in Mumbai, you have seen. Those who are coming to Mumbai, you can see this. So under this banyan tree in 1875, first derivative transaction was started with the cotton trade with European countries. So there was very good demand of Indian cotton in European countries, and cotton traders had started betting with different prices. That's how this Bombay Cotton Trade Association was formed. That was the starting of BSE, Bombay Stock Exchange, in 1875. Thereafter, since derivative involves several deliveries and counterparty risks are there, government has banned this cash settlement of option trading. Only you can participate in the physical share trading. But thereafter, when all over world derivative markets demand was going up, Government of India has prohibited like option trading in 1995. Then further in 1999, government has set up two committees. SEBI has set up two committees, and based on those committees' recommendations, one is LC Gupta committee and another is Professor J.R. Burma committee. So derivatives has been included as one of the securities under our Securities Contract Regulation Act. We started from 2000, equity derivatives started in our market. We started with the index futures, then index options, thereafter stock futures and stock options. In 2003, we started commodity derivative market, although commodity regional exchanges and commodity trading was a old concept for India, but in a nationalized exchanges, commodity started from 2003. And currency derivative started in 2008, and interest rate derivative actually started from 2003. Further, it got failed. Again, it is started from 2009. It got failed. 2011, it got failed. But this last fourth time attempt was there. Say from 2014, it is picking up. The transactions are picking up. There are certain things we'll discuss when we'll move to that interest rate derivatives. What are the causes of not having much transactions on those interest rate derivatives. So when we look into these two categories, exchange traded and OTC, in OTC normally banks and financial institutions are participating at a larger way, but in exchange traded derivatives market, we see all these categories of investors. We divide those investors into two buckets. One is institutional investors, another is non-institutional investors. Now, further, we divide those institutional investors into DIIs, domestic institutional investors, or FPIs, foreign portfolio investors. And those non-institutional investors are divided into HNIs, high net worth individuals, then retailers, then Hindu undivided families, like this. So we'll see who are participating at a larger extent in these derivative products. So when it comes to forwards are more risky because it is one-to-one transaction and one-to-one deal. So counterparty risk is huge in the forward transactions. But when financial institutions are participating, they don't normally commit defaults. So that's how more forward transactions are happening in the OTC market. So we can go long forward or short forward. We can also go for future, which is like forward, but future is a exchange traded standardized derivative product. And in future, we don't have counterparty risk. We have clearing corporations and we have exchanges to monitor with margining systems. And futures are highly liquid and the pricing of future contracts are standardized. But in forwards are customized products and these are all OTC products. There is no margin, so counterparty risk is there. And it may be liquid or it may be illiquid or there are no transparency. In future, if we look into any of the contracts that are available in the exchange, so say for example, index future, we'll get three contracts. One is near month, another is mid month, and third one is far month contracts. And all the details we can get it, the contract specification, lot size, and others in the exchange website. Now I'll briefly introduce you option market, then we'll go for equity derivatives, currency derivatives, and interest rate and others. So option is a contract which is giving the buyer the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. So if a contract is expiring on the certain date, then it is called European option. If contract is expiring before a certain date, it is called American option. So we don't have any American option in our market, we have European option. Then if it is right to buy, it is called as call option. If it is right to sell, then that is called as put option. So in the option, one very good part is the holder or the buyer has an option to exercise or not to exercise. Just like in our example, we have seen if I will not exercise, I will lose my maximum loss as a buyer will be my premium that I paid. So the holder will exercise when option will give profitable or option will give him a positive payoff. There are certain terminologies like if underlying is index, then it is called index option. If underlying is stock, it is called stock option. Then the buyer of an option who is paying the premium and the seller of the option receives premium, and seller is also called as writer of the option. And the call option and put option we just discussed, American and European option we have discussed. Now this option price is very much important when we deal with options. Option price gets decided through 5 factors. You can tell it as Shahrukh Khan in TV, SRK TV. We need spot rate, we need risk-free rate, then we need K, which is future rate, then T, which is time to expiry, V is volatility. So it is based on option pricing models. So we get the option pricing, then that gets traded in the market. And each option has a expiry date. Index option has a weekly expiry, and stock option is a monthly expiry. Then strike price is the exercise price. In option, we get three categories of options. One is in the money, another is at the money, and third one is out of the money. We call it as ITM, ATM, and OTM. So in call side, if spot is higher than future, then if it is call option, it is called as in the money option, in the money call option. If spot equals to future, S is spot, K is future, then it is at the money option in both the sides, call and put. In out of the money, if spot is less than future, then it is called as out of the money call option. The reverse is on the put side. If spot is less than future, then it is called in the money put. If spot equals to future, then it is at the money. If spot is greater than future, then it is called as out of the money put option. So why it is important when we do option trading or option when we take option positions, we should aware about the option chain. This is coming from the option chain, and we do option analytics based on this option chain. Then these participants, all of we are aware, there are three categories of participants. The main objective of introduction of derivatives is hedging. So who has the exposure to the underlying, that participant will hedge. So suppose say in our first and second example, one equity holder or wants to buy equity is exposed to equity market risk, so that he will hedge. So we reduce the risk when we hedge. Speculators speculate the price movements. They see the price movements with different strategies. Then they take a long or short position. And the arbitrageurs are getting benefit out of the differentiation of two market prices. Suppose say there is so arbitrage can happen between future to future, one expiry to another expiry, future to spot, or spot to future, or future to option. So if there are differences, then we get arbitrage benefits. Now we'll move to categories of derivatives that are there in our market. One is equity derivatives, second one is commodity derivatives, third one is currency, and fourth one is interest rate derivatives. On the equity front, we have four categories of derivatives: stock futures, stock options, index futures, and index options. And if we'll see, there are around 196 companies whose futures and options are available, or they are allowed for F&O segment. There are certain criteria which company has to satisfy to enter into F&O segment. So this also depends on the liquidity of that company's share in the cash segment or in the spot market. If we see, there is a expiry date on which that particular contract will expire, and when it gets expired, the settlement happens. What is that settlement? It may be a cash settlement, or it may be a physical settlement. So all these index derivative products are cash settled, and stock derivative products are physically settled. If someone will not be ready to take those physical settlement, they come out before the settlement date. Then lot size, there is a concept of lot size, or the minimum contract we buy from this derivative markets. So lot size is not there now in spot market. It was there earlier when physical share trading was there. So lot size is the minimum quantity we need to buy. And the open interest gives us a very good indication whether it is liquid or not. So one buy and one sell creates one open interest. If open interests are more, that means more positions are built up. Then based on open interest also, there are certain strategies we follow. Then margin is there for the risk management purpose. When we enter initial margin, mark to market margin and upfront margins are there. Then we can go for long or short in these futures or options. So the settlement type can be cash or physical. This is one very, very interesting graph I'm presenting in front of you. This is the source is from SEBI Handbook of Statistics. So this graph is on mode of trading in equity derivatives at NSE. So mostly 96-97% derivative transactions in India are happening with NSE. So if you look into this mode of derivative transactions, equity derivative transactions, first one you can see algo, then non-algo, direct market access. Your transactions will go through brokers, but directly you are placing to the exchange. You need to open one account for direct market access, but brokers intervention will not be there in this direct market access. Then Fo&Now is another platform NSE has created for speed execution of the orders. Thereafter, co-location. Co-location is a very good concept for again speed execution of the orders. When the speed of execution is depending on microseconds. If one trader is there or one broker is there at Delhi, broker's trading terminal is Delhi and exchange is in Mumbai, and one broker is there in Mumbai. So Mumbai broker's trade will execute at a faster rate than Delhi broker's trade. That's why exchange brought out one very good concept called as co-location. Broker can keep their trading terminal inside stock exchanges so that each one of the broker will get same time of trade execution. So when it comes to co-location, broker will pay some fee to keep his terminal in the with the exchange. And there are like liquidity has been increased after this co-location has been allowed. Then internet-based trading, we log into our laptop or our system. Then mobile-based trading. Just see, this non-algo trading was 75% in 2010-11. And it came down to 13% or 16% in 21-22 and 22-23. But the algo transactions where there it is not much. You see the co-location transaction. Co-location is transaction is increased like anything. So 50% of total trade is happening through co-location. Then our internet-based trading and mobile-based trading are like internet-based trading is almost on an average 9-10%, and mobile-based trading is only 10%. So what it indicates is more transactions are happening through co-locations. So the speed of execution is also very high through co-locations. Now, if we see the index futures and index options in index derivatives, if total will take 100% transactions are happening in index derivatives, almost 81% was index options in 2010-11 and 19% was index futures. But this option is the most beautiful lady in the securities market. Now, if you see 99%, 100% transactions are happening in index options as compared to index futures. So index futures transactions are almost zero, means 0.00 something. It was following 2%, 1%. So if we come to the stock exchanges which are dealing with or which are giving the platform or creating the derivative contracts are NSE, BSE and XMSE. XMSE is called as Metropolitan Stock Exchange of India, though liquidity is less in that XMSE. NSE, BSE are the oldest exchanges. Coming to the commodity derivatives markets, we again had a very long history on this commodity derivative transactions, our BSE was started with commodity derivative transaction under that banyan tree. Now we have almost 140 years on futures trading. There were certain acts like associations like Bombay Cotton Trade Association, then Gujarat Vyapari Mandali 1900, and Chamber of Commerce Pur in 1920. Those are all old commodity exchanges. Then futures trading in jute was being organized in the Calcutta Exchange in 1919, and East India Jute Association in 1927. But 2003 onwards, we are moving a new era to the commodity derivatives market. In commodity derivatives, two categories of commodities has been divided. One is agri-based commodities, another is non-agri-based commodities. So in the agri-based, again, we divide them into unprocessed, processed, and livestock. So in non-agri, we divide them into metal and energy and complex and other derivatives like petroleum products. In metal, precious metals and base metals are there. So in some markets, livestocks are also getting traded. We don't trade with livestocks, but unprocessed and processed farm produce are traded in our market. If we look into, just like we have closed down all the regional stock exchanges, we have also closed down all the regional commodity exchanges because of huge e-trading platform provided by these national exchanges. Commodity like local or regional commodity exchanges were not getting volume, and they were still following the physical share trading platform, and they were not able to move to this e-trading platform because huge IT investment was required. So currently, multi-commodity exchange MCX, which is known for metal tradings or metal products or non-agri products, you can say. Then NCDX, which is known for trading with agri products. Then ICEX is there, which is called as Indian Commodity Exchange Limited. And from 2015 onwards, FMC got merged with SEBI, and commodity has been considered as one of the securities under Securities Contract Regulation Act. And after that, SEBI has permitted all the exchanges to start their commodity trading. So NSE, BSE are also providing platform for commodity trading. Now, if we see the commodity trading turnover, again, participant wise, so if you see farmers and FPOs who are farmer producer organizations, participation is less. Little higher is VCP, who are value chain participants, who are suppliers and other value chain participants, or especially hedgers. And if you see two categories, proprietary traders and others category, they are participating at a larger extent over the years. And domestic institutional investors and foreign participants are limited. Only we have allowed them to participate little later as well. Then in NCDX, similar cases, proprietary traders and other categories are trading at participating at a larger extent. And value chain participants and hedgers are also participating at a larger extent. Now the timing depends on like internationally referenceable non-agri and agri products. So it is like up to 5 p.m. and up to 11:55 p.m. MCX and NCDX are open. For again, it depends on different commodities. The timing depends on different commodities. So when it comes to interest rate derivatives, mostly banks and the investors who are investing in the interest rate products are exposed to this interest rate risk. So government of India, so we have introduced the interest rate derivatives from 2003. Keeping in mind, like this interest rate derivative is traded at a larger, say, extent in international markets. if we consider all the products, like all the financial instruments, interest rates are highest traded instruments in all over the world. But this particular product is struggling in Indian market. You'll see. So these are all cash settled. In between, we have introduced physical settled in 2009. So the underlying for this interest rate are 6 years, 10 years, and 13 years Government of India bonds. And we have introduced in 2011 91 days T-bill, but that is not having any volume. But others like 6 year, 10 years, and 13 years Government of India securities are having volume. So just like I told you, in 2003 we introduced this, was not able to attract any good amount of volumes, and again it got reintroduced in 2009 with a, you say, customized or with a relaxed norms. So whenever we introduced any products has a feature or product has a characteristics, we have certain terms and conditions, like there were ZCYC, zero coupon yield curve, and in 2009 we have introduced physical settlement, and in 2003 banks were not allowed to participate. All those has been relaxed time to time, and from 2014 onwards this is picking up. So this is the region wise notional amount outstanding in interest rate futures. If you see, it is not India. The Asian exchanges are not having are having less, you say, list volumes, second list volumes, but others are having highest volumes. So if we look into in the historical point of view, Chicago Mercantile Exchange is introduced that interest rate derivatives from 1981. Then we had a small paper on this interest rate derivatives, myself and my guide, my mentor. So in 2014 when it got introduced, we have seen like good amount of volume. So there were the causes of failures. I told you ZCYC, which was zero coupon yield curve, which was like not very easy to understand by the participants. Then banks participation was limited in 2003. That's how it got discontinued, or it was failed, you can say. Then in 2009, we introduced the same with the physical settlement, and we allowed banks to participate. Thereafter, then again, when physical settlement is there, you will take the long-term bond like 10 years, 15 years Government of India bond and hold it for a longer period of time. Then again, third time, it was 91 days T-bill. It was not also having any liquidity, so limited volatility is there on 91 days T-bill. So first in 2014, so this product is combination of intervention of RBI and SEBI, because you think about Government of India securities, the cash market, or you say the spot market regulator is RBI. When it comes to derivatives, the derivative market regulator is SEBI. So again, the same thing happens in case of currency derivatives. So both come into together to launch these products. So that's how in 2014 this product got introduced, and it got good amount of volumes initially. Now also it is picking up. Then in currency derivatives, we started in 2008 with one currency only, USD INR, and most of our transactions are happening, around 90% transactions are happening with USD INR. But currency option was introduced in 2010, and futures and options with other pairs of currency like Euro INR and GBP INR and Japanese yen INR started from 2018. And the cross currency futures like Euro USD GBP USD and USD JPY were introduced further from 2018. Now this currency derivatives trading on the exchange was launched in say November 2013, and trading has been commenced from Friday 2013. Now currency trading shall commence on the contracts on US dollar, INR and others, and currency derivatives trading shall continue with USD dollar. Now how many like currency derivative products are available in our market? In terms of INR pairs, we have futures and options of these 4 major currencies. In terms of cross currency pairs, we have futures and options of Euro USD, GBP USD and USD JPY. Now coming together, all these 4 derivative transactions, whatever turnover is happening in equity, commodity, interest rate and currency, which category of derivative is contributing how much to total derivative transactions of India? We have calculated and we find like 97%, around 98% transactions in derivatives are happening through equity derivatives, and next is currency derivatives around 2%. Commodity and interest rate still need to go like long way. Although commodity derivatives transactions were more in 2011, 12, 13 and onwards, but it started coming down. Other derivatives products were introduced, and some of the derivatives also got discontinued. So that's how commodity derivative transactions came down, but equity derivative transactions has gone up. And currency also, we are in a very good position in the currency derivative across world. In fact, we are number 1 in currency futures and currency options. Now, if I look into the SEBI brought out one report, whenever we see any influencers or YouTubers, they will say, I bought this flat in Mumbai or Delhi or in Kolkata because of trading in options. I bought this BMW because of trading in options, but actually they don't trade with options. So they only earn by giving you recommendations and false recommendations, you can say. So in the post-COVID era, we have seen, I think during COVID itself, we have seen so many new individual traders came into market. That's how our DMAT also has gone up like anything. SEBI has brought out one report in January 2023 on this. The title is Analysis of Profit and Loss of Individual Traders Dealing in Equity and Future, Equity Future and Option segment. You see, in 2019, there are 7.1 lakh traders, individual traders were trading. And in 2022, 45.2 lakh traders started trading. And they were active traders. And it is a jump of 500% participation. Now, that is good. More participation is good. But another interesting part is out of all these individual traders, more than 80% were male. So male wants to take more risk than females. Maybe for that's how 80% were male. But another most important part is 89% of F&O individual traders who are participating in F&O segment are incurring losses. Only in 11% are getting profit. Okay, and the average loss is 1.1 lakh in financial year 2022. And if you see 90% of the active traders, their average losses were 1.25 lakhs. Now, you see 11% individual traders earned profit. Now, if we'll see 90-80% individual traders traded in options. So future is there, but 98% are trading in options. That also we have seen in the participation in the category of index option and index futures. Almost 100% is activities are happening in index options. Okay. So over and above, net trading loss incurred because of transaction costs. Even if I earned profit, but I pay more transaction costs. That's how my loss level are keeping on increasing. Now, if we see what are the role of ICAI and members and NISM on this derivative market. So derivative accounting is a separate instrument accounting, which is the role of ICAI members are very much important. Although I am not from the accounting side, my brother is a member of this ICAI. So all the treatment of each of these transactions, hedging, speculation, and arbitrage transactions are there in the costing side. So more role are there. When it comes to NISM has 4 certifications of each of these derivatives. Those who are working with the derivative desk or with the exchanges or any of the MIIs or broker firms, it is mandated that they have to write these derivative certifications. And in every 3 years, they have to rewrite, because this market's development are happening faster than any other developments. So in every month, we are getting at least 4 or 5 circulars on derivatives. So many changes and strengthening in the equity and risk management side is there. So that's how time to time we bring more stringent regulations. Now, the last part will understand where we stand in terms of world derivative markets, where India stands. If you see top 10 exchanges, so these figures or this data are provided by World Federation of Exchanges. World Federation of Exchanges releases monthly statistics as well as annual statistics of each of these products and exchange-wise transactions. And you can also get something from NSE yearbook. See, NSE is the number 1 in all derivative transaction. If we put together number of contracts traded, it is not the value of contract traded, it is the number of contracts traded. This B3 is Brazil future exchange, Brazil futures and option exchange. So others are behind like an NSE or India. If we look into in the single stock futures, so we have seen like more futures transactions are not happening in India as compared to options. See, NSE is coming into number 4. And if we go for single stock options, I told you there are around 196 companies who are there in the F&O segment. So NSE is number 6th. NSE is number 6th. If we go for stock index options and the growth, again in the stock index option in 2022, NSE is number 1. And if you see stock index futures, again NSE is number 4. Sorry, NSE is in the top 10. NSE is number 8. Now, if we look into currency futures, we are again number 1. And when other markets are giving year-on-year growth in negative value, we are in the highest or 55% year-on-year growth we are giving to these transactions in currency futures. And same happens in currency options. So India is number 1 in terms of currency option transactions. So when it comes again, it is the number of transactions, not the value of transactions. Now in the interest rate futures, we are nowhere. I told you in the interest rate options, it is it is there in the 10th position only, although all others are having very less transactions. So what are the key takeaways from this this session? I'll suggest all of you learn the concept thoroughly before you participate in the derivatives trading, and mostly start paper trading and examine your effectiveness of your strategy, effectiveness either your hedging or arbitrage or speculative strategy. There are nowadays very many free websites also. They provide paper trading options with some notional money. So then don't use derivative every day, or don't think you will become the richest person with trading with derivatives. Then don't borrow and trade in derivatives. That's how many cases comes in newspapers you have seen. So traders commit suicide as well, because derivative is such a emotional product. Once you will not control your emotion, then your loss level will keep on increasing, and there are so many instances that are happening. So when it comes to hedging, when it comes to speculative and arbitrage strategy, as a individual trader, we should be very careful. Don't get motivated by these influencers. Start to write derivative certifications to enhance your skill before you enter into any derivative transactions. After all, use derivative for hedging purpose. So some of the derivative reading materials I am placing over here, NISM derivative certification books. So I have kept the link for this. You can download freely from our NISM website. You need to only register, that is again freely. You can enter your email ID and mobile number, and you can download freely. And those who wants to go deeper into it, you can go for option volatility trading strategies and Jansi Hall book. All of you are following. With this, I close my session here, and I love to take questions.
So, can you give some more presentations, sir? We are having some questions are coming. We are getting even
Okay.
more questions.
Okay. Okay. Yeah. So you want me to present for some more time?
Yes, sir. Yes.
Yeah. So let me introduce the option chain, which will help the participants. So let me introduce each of these products. Say NSE, if you go to NSE website, okay. So I'll go for market data, and if you will go for derivative market and indices are there. So I'll first go to derivative market. Under this derivative market, you see total equity, currency, commodity, and interest rate derivatives are available. Now I will go for top 20 contracts. If I'll select only index options or Nifty 50 options, let us first understand about stock futures. If I'll go for stock futures and click on this Reliance, then I'll get the activities of these stock futures. Okay. So there are two books. One is order book and another is trade book. If you see this order book, there are buy side orders and sell side orders with quantity and buy price, and quantity of sell price and quantity. These order books are freely available to all of us when we participate in any of the derivative transactions or even in the spot transactions. First, you understand how depth the order book is. If you see in the total buy order quantity was 2,78,000, but sell order quantity is 9,04,000. This gives little indication of the bearishness of this particular product because more sellers are lined up as compared to buyers. Around 3 times more sellers are 3x more sellers are lined up. Then if we will come to this trade book, we'll get trading volume, how many contracts got traded, total value of trade. So this is on a real-time basis we can see, and value weighted price, average price, then market lot. So minimum lot is 250. Then open interest, this 1,68,000 open interest, these many open positions are there, and changes in open interest for 24. Then percentage of change in open interest on yesterday's. Thereafter volatility, daily volatility, annualized volatility, and implied volatility. So implied volatility is there in case of options. Then settlement price. Now this is one most important part is market-wide position limits. So client-wise position limits are there and market-wide position limits are there. My website, my screen is visible, madam. NSE website.
Yes, sir.
Okay.
It is visible.
So what does this market-wide position limit mean? Let me explain here. When it comes to position limit, many times in the newspaper, those who are reading newspapers, we have seen like there are some companies are banned from F&O, okay, banned from F&O segment. Okay, so they are banned from F&O segment. That does not mean they are banned forever. They are banned for a certain period of time. Why they are banned? It is not a negative part like they are banned. If they are removed from the F&O segment, that is different part with less liquidity or so. But when it comes to banned from F&O segment, it is because of position limit. It is because of position limit. Okay, so how this position limit gets decided, let me tell you. So how does this position limit gets decided? First is we'll see whenever we are building a equity derivatives, whenever we are building, there is a concept of market capitalization. Market capitalization. This market capitalization is again divided into two categories. One is total market capitalization. Another is free float market capitalization. One is total market, another is free float market capitalization. Now, when it comes to free float market capitalization, the shares which are there in the public, we get the market capitalization of that shares. Suppose say for one company, market capitalization is 100. Now the regulation says we allow 20% of free float market capitalization, 20% of open interest of free float market capitalization. Okay, 20% is 20. So further, if open interests are keeping on building up, then the risk of physical delivery is there. So when it comes to risk of physical delivery, if I am transacting, then I am a seller. I must bring the underlying, because stock derivatives are physically settled. I must bring those shares to give at the delivery on the expiry day. If these transactions are keeping on increasing, that means open interest are keeping on building up. That means more speculators are taking positions. So this open position or position limit is there to restrict the open interest. What will happen? Further, we say 80% of this 20%, 80% of this 20%, if open interest reaches, if say 80% of this 20% is 16, if open interest reaches to 16, then we say we will not allow any new open interest. New OI will not be allowed. So I hope all of you are aware about open interest. So one buy and one sell creates one open interest. Now, if new OI will not be allowed, the existing OI, existing open interest, those who are having, they can square up the positions. Whatever existing OIs are there, they can square up the positions. Further, when it comes down, then only we will allow that particular stock derivatives to enter into or to receive the new positions. Okay. So during this period, when it reaches to 16, we not allow the new open interest. That means we say banned from F&O segment. Okay. Banned from F&O segment. So it is like if more people are taking these positions, it may happen, it may accelerate to more risk or it may hamper liquidity. So this is one of the restrictive regulation. The objective is to maintain liquidity and reduce volatility. If volatility will be more than if liquidity gets hampered and more risk we are creating, then that is not the objective of introducing the derivative product. So this is one concept of open is position limit. So this position limit is combination of both futures and options OI, both futures and options OI of that particular stock. Once it comes down, then it will resume to receive the new say new contracts or new positions. Okay. Then we'll move to understand what is this. Let us go to index 1. What is this? So I'll go to Nifty futures. So there are again three contracts. Okay, so there are three contracts. You can see 28th September, 26th October, and 30th November. Three contracts are available: near month, mid month, and far month. And in each contract, you can see the order book, trade book, and its daily volatility and annualized volatility. We don't have position limit on this index derivative. Why? Because we don't do settlement. Physical settlement in index derivative. The index derivative settlements are cash settlement, not the physical settlement. Now, if I go to option chain, this is very interesting. Let me tell you what is the importance of this option chain. So before we enter into any option transactions, we should understand this option chain so that we can take a view whether to go for buy, sell, or we can understand the liquidity. Okay. First one is OI. So I told you one buy and one sell creates one open position. Then changes in OI today changes how much changes has happened. So today market is up. It is this data as of yesterday. Then volume, there is a difference between open interest and volume. Volume will give you today's whatever transactions you are doing. Open interest will carry forward the open positions and will add. Then IV is implied volatility. Then LTP. LTP is your last traded price. So this is the option premium or open interest. Or option price, option premium or option price, that last traded price. Then how much change has happened to this last traded price? So today's last traded price, how much change has happened as compared to yesterday's closing price? Then bid quantity. So this is the first layer of the order book. Bid quantity, bid, which is the bid price, willing buyer's price. Then ask quantity, ask price and ask quantity. So willing seller's price and willing seller's quantity. And this left hand side is call and right hand side is put. We have two options. First, we'll understand one thing which is called as moneyness of the option. Then we'll go back to decide the support and resistance, and we'll see other things. And if you see the transactions or the open interest, you come down, open interest here is more. So this point is the at the money point. So this point is the at the money point. Okay, this point is the at the money point. Near about at the money, you are getting a good amount of say transactions. Then if you go far, either you go in the money or out of the money, so there are less transactions. Let us first understand which is in the money, which is out of the money, and which is at the money. So this is the strike, or which is future price, or we call it as strike price. And this is the spot price. 19,435 is the spot price. If I'll go for 19,435 spot and strike is 17,750, spot is higher than the future. So this will become in the money, at the money, or out of the money. This will become the in the money call option, because here future is higher than spot, or spot is higher than future, or future is lower than spot. So spot is higher than future. If you go up to say 19,300 also, future is less than spot, or spot is higher than future. If you go for 19,450, future is say 19,500. Again, spot becomes lower. So if spot is lower than future, then this will become out of the money. And if you go up 20,000, 20,500, so these are all out of the money. Now, if we will go for out of the money, you can easily also identify this shaded area and the white area in terms of call option. If it is in the white area, this is out of the money. You see 19,500 and above is the out of the money. And if you go to this shaded area, this is in the money call option. If we'll go for the other part, which is your put option. Now, in case of put option, if spot is higher than future, then it is in the money or out of the money. This is called out of the money. Okay. So if spot is higher than future in terms of put, then it is out of the money. If I'll come down again further, if spot is say lower than the future, spot is lower than the future, then it is in the money put. If spot is lower than the future, then it is out of the money call, but it is in the money put. Another interesting part, you see the option price, or that last traded price in the out of the money or OTM is very less, and if it is in the money, it is more. Both the sides you can see, if it is out of the money, it is less. If it is in the money, it is more. One more part we can look into here is highest OI or highest open interest in the call side and highest open interest in the put side. So let us see, highest open interest in the call side is this 1,33,000. So this 1,33,000 is the highest open interest in the call side. Then highest is 1,36,000. Then second highest is 1,33,000. And go to put side. In the put side, 1,87,000 is the highest OI in the put side. Just see the strike, 1,87,000. The strike is 19,300. And here the strike is 1,36,000, 19,600. Just see 19,300 and 19,600. So 19,300 is put OI, highest put OI. 19,600 is highest call OI. Now this two gives us two indication, like this 19,300 will be support 1. Okay, that means it acts as a support, and 19,600 acts as a resistance. Okay, so you can say resistance 1, you can also create resistance 2. What does this support 1 and resistance 1 indicates us? If price will come down, then it will come down to 19,300. Then it will bounce back. So support, it will not cross the support. Then in the upper side, it will go to 19,600 and bounce back. That is one part. Second part, it can break the support or resistance. So first is less chance is there to break the support and resistance. Okay. If it will break, then the resistance 1 will become support 1. It will become support 1. If resistance breaks, then one more support will get one more resistance will get created. It may be, we can see the next highest. So it may be 1,05,000, which is maybe 19,700, maybe. Yeah, 19,700. So the next resistance will become 19,700. Then this support will become, this resistance will become support. Same thing happens in the support side. If support breaks, then the next support will get created. The next support will get identified at, say, 99,000, which is 19,200. So next support will be 19,200. How does it helps us? It helps us to see or keep our target and stop loss. I hope all of you are aware about target and stop loss accordingly, and we can see how much probability is there, like it will go up or come down. Now there is no guarantee that it will cross. Okay, so no one can give you guarantee that it will cross. Maybe it may cross or it may not cross. That is what the option chain is. Now if I will take a position of this 19,600, say, how much I will bear like cost. So this 5.55 multiplied by lot size will be my cost of entering to that trade. And the buyer, who is the option buyer, will bear the maximum loss for option buyer is the option premium, whatever he pays, and maximum profit for option seller is the option premium he receives. Okay, so this option premium buyer pays and option premium he receives. Now let us understand the transaction cost. Whenever we enter into this type of trades, we bear also huge transaction cost, and we have seen like even if we have earned some profit, but our transaction cost is higher than the profit. So net to net we are in loss. So let us see two option two brokerage calculator I will show you. So I'll say Zerodha brokerage calculator. Then so this is one of the discount broker houses calculator. Then we'll go for say ICICI brokerage calculator or BSE to NSE brokerage calculator. Okay. So this is ICICI brokerage calculator. Let us see. We'll not go to intraday equity delivery since we are in F&O futures and options. We'll just understand if I bought it, say, but it's say 100 rupees and I sold it say 105 rupees. So I am understanding I'm in the appreciation part, or I am making good amount of profit. So if we will see the quantity, you say lot size is 500. Okay, and you see how much total charges what are the charges I'm first of all paying is brokerage charges, then STT, which is security transaction tax, then exchange transaction tax, then clearing corporation charges, and GST. GST on this brokerage plus exchange transaction and clearing charges transaction. Then SEBI charges, stamp duty, state to state it differs. Total transaction cost I am bearing is 46 rupees, and net profit I am earning is 2453. Now the lot size is like one lot is 500 quantity. Now the same transaction in the future we'll do with the full service broker house or ICICI broker house. Let us go to futures and options. Say 100 rupees I bought, I sold at 105, and the quantity is 500, number of lot is 1. Okay. Now you see I am bearing 64 rupees transaction cost. Here I was bearing 46 rupees transaction cost. Now, and I am earning 2435 rupees. Let us come to this option and do the same transaction. We will buy at 100 and sell at 105, and the quantity will become say 500. Now I am bearing 143 rupees transaction charges, and the net profit and loss is 2356 rupees. In future it was 2453 rupees because I was bearing only 46 rupees transaction charges. If I'll come back to this ICICI broker, I'll say 100 rupees buy and 105 sell. Quantity is 500. Number of lot is 1. Then I'm bearing 278 rupees and my profit is 2221 rupees. So nowadays also broker houses started giving you the transaction cost in total, how much you will bear when you enter into the transaction. So be careful about entering into a trade and look into the transaction charges that we are bearing. So with this I'll stop here. It is time to take your questions and answer it.
Sir, I would like to thank you for the meticulous presentation, and you covered the practical examples in detail, sir. So we are having a lot of questions from our participants. We'll start with them. So the first question we got is, what is the difference between long forward and short forward?
Okay, so long forward means I am buying the forward. I am bullish on that forward. Okay, if I'm buying it, I'm saying I'm long forward. If I'm bearish, I expect price will come down. I'll say that I'm taking a short position. I sell fast and buy later. That is called as short forward.
All right, sir. Second question is, which platform is good for paper trading?
Okay, so for paper trading, there are so many platforms. I can't say which is the good one, but you can try. Sensible is a very good platform. Money Control gives Money Buy is a very good platform. You can look into others. There are so many say dummy trading platforms, but you should be very careful. Don't give your bank details over there. Okay, at any cost you don't give. So mostly Money Buy of this Money Control gives very good option, or Sensible you can go. They also gives very good option. They will give you some virtual money. You can take a virtual trade and see how much profit and loss you are making.
All right, so I personally have a question, sir.
Yes,
like, what is high frequency trading, and how is it related to algo markets?
yeah, so high frequency trading, madam, is depending on creating one algo. What is that creating one algo? I'll create one program which will automatically buy and sell. I'll just run that program, so it will buy and sell. But to run that program, I want 0.1% off if it goes, sell it, 0.1% down if it comes down, you buy it. So it will automatically buy and sell. If you see in 1 second, even 1 millisecond also, 1,000 times it buys and sells. Okay, that is called as high frequency trading. Now in that high frequency trading, there are so many ways to do. One is this algo trading. Another is this co-location. So co-location also does the high frequency trading. In that high frequency trading, there are like retailers are not very participative, because first is it is little costly to opt for those algos, and second is more and more institutional traders are participating over there. So proprietors are also participating on those high frequency trading. Yeah, that is one.
So the last question is, what is beta value of volatility in equity market? Is there any parallel parameter in F&O segment akin to beta value? This is from one of our members.
So it is, we can't say beta value, but the parameter what we consider over here is the VIX, which is our volatility index, which gauges the say option price volatility. If we look into this VIX moment, volatility index moment in the history, it ranges 15 to 20%, 22% max. But when we look into during the uncertainties, or we say financial crisis period or COVID period, this VIX value goes up to 80-90%. So that gives us indication like this is the riskiest moment to enter into this F&O segment.
Thank you, sir, for the
Welcome.
for the presentation and taking all the questions, sir.
I think while many questions are coming up again, I think 2-3 questions.
Okay,
Just,
you can.
Yes, sir. Yes, sir.
Read.
Look at it.
Oh, I can also see.
I think.
Yes, sir. There's one question. What is the reason for 89% of individual traders in FNO incurring losses?
See, this is one difficult question, I can say. First of all, why I'm entering to that trade as a individual trader? So this moment is got increased in this during this COVID only. What happened? Many influencers started their YouTube channels, and people also got to know that market is going all-time high. Okay, then there were certain thing which is attracting me. My greediness is keeping on increasing to enter into directly option. So many new entrants or new traders, they directly enter into option without understanding anything, only to listen to these influencers or YouTubers and entering into the trade. So that is the main cause, like we don't enhance our skill first, rather we simply enter into a trade thinking like that fellow has given me some screenshot of his trade, he has got this amount of profit, but those screenshots are also manipulated screenshots. So that is the thing, like we should aware about our knowledge, our capability, our understanding before entering to any of the trade. Don't listen to anyone and trade. So that is the main cause, like huge individual traders are getting a loss here in this post-COVID.
So we are having like more questions like why are options traded only in lots and not like regular stocks?
Okay, see, regular stocks were also traded on lots when physical share trading was there. First of all, we don't encourage more small participants to come into derivative market. So that's how lot size, minimum contract size is there. And second is, the main objective of this derivative is for hedging. So whosoever will hedge should have some say exposure to the underlying, then only he is coming to hedge. That's how lot size is there. When lot size was there during our physical share trading and equity segment, that time what was happening, the transfer of physical ownership, transfer of records, physical records, and the cost of these transfers were very high. That time also we are having lot size in stocks, but we don't keep lot size now because it is online trading platform we are trading. Secondly, when I enter into regular stock, I hold or I square off, that does not impact much. But when I enter into derivative, the delivery is a biggest part, which is the settlement. The settlement either will happen physically or it will happen the cash settlement. Now, to discourage small participants to participate, we keep this lot size. Again, to increase the liquidity in the derivative market, we also keep the lot size.
Okay, so member has asked, sometimes he has noticed in index options during expiry, he has seen difference in strike, spot differs, and he's asking the reason why.
No, say the settlement will not differ. So there will be small differences between these two prices, but when it comes to settlement, settlement price will not differ.
All right, so member is asking, who are proprietary traders?
So proprietary traders are the members of the exchange or the broker houses. You can say one broker house. If I have a broker house, so many clients can register with me. They will trade. I will provide the platform, and I can trade myself also. I will have one proprietary account. So those broker houses are having their own account, which is called as proprietary account. They trade for themselves.
Yes, sir. Someone is asking, kindly explain butterfly and option strategies.
Okay, butterfly option strategy is not an easy task. First, you have gone to butterfly part. First, we have to understand the option payoffs. Then we'll go for spread. Then we'll understand straddle and strangle. Then we'll go for butterfly. So if you want to join, if you want to learn, you can join our derivative trading, which is scheduled on 9th and 10th of this September. I'll conduct this 2 days session on this derivative strategies. There we'll cover whole things. So what is that butterfly?
Yes, thank you, sir. Some member is asking, please suggest some books to read as trader come investor.
Yeah, so I'll share this PPT, sir will share with all of you. And one more book, since member is asking for trader come investors, read one book by Come Into My Trading Room by Dr. Alexander. Come Into My Trading Room. That Dr. Alexander is a broker, and he has very good experience, and he has written 2 books. 2 books are excellent books. One is Come Into My Trading Room. Another book is Trading for Living. So you will understand both the sides, trading and the investment, as well as the psychology. Our psychology changes in different market sentiments, how human psychology changes and human sentiment changes, how to control our sentiment with different situations. These 2 books are very good. You can go through. I'll add that into my PPT and share.
Yes, sir. Thank you for that. And they having one more question. Is there any chance for increasing trading timings in NSE or BSE?
Okay, that is not the answerable question, but if it gets increased, it is good for the market, because why there is a plan to increase, because international markets are on when our markets is off. But there are some challenges in terms of these brokers and others, but it may increase. So that is good for the market. Liquidity will keep on increasing. Again, those who are doing job during daytime, they will not get time to participate in the market. They will get time in the evening to participate in the market.
Thank you, sir. That was like
Welcome.
very informative, and you have answered the questions very
I
well.
think
Welcome.
2-3 more questions have come in.
Yeah, please.
Yeah.
So you can see it's like a very popular session, and members are like already asking for PPTs.
Yeah, PPT will provide.
Yes, sir. So, like, what is the largest derivative in the world?
Largest derivative instrument, if you are asking, that is interest rate derivative. If you are asking largest derivative exchange, that is National Stock Exchange of India.
Okay, sir. So, there is one more question from a member. Even though having enough margin, brokers won't allow execution of trade during 9:15 to 9:30 time, saying not having enough margin sometimes.
Yeah, so see, there are 3 or 4 times this margin gets changed, margin calculation gets changed. Every 1.5 hours, the margin gets changed. So if you go to any of these brokers, if you start entering to your order book, you will get how much margin is required and how much margin you have. So this margin, maybe the amount of margin required is high during 9:15 to 9:30, because that is the entry of the market, that is the starting of the market. Huge participation is happening during that time. Later on it get reduced, maybe later on you got a chance to enter with your available margin. So that is because time to time this margin calculation gets changed. So that is based on different volatility and liquidity. There are certain ways that this margin gets calculated.
All right, sir. We have 2 more questions.
Yes,
what
please.
is called American and European and option trading?
See, there is a expiry date. Suppose one contract, say weekly expiry contract is expiring on this coming Thursday. If that contract is getting settled down, that means getting closed down before Thursday, any days before Thursday, that is called American option. If that contract is getting only closed down on Thursday, because in the contract it is decided the expiry date is the Thursday, then that is called European option. If we will introduce American option, the challenge is it is more risky for the participants as well. We don't know on which day it will get expired and which day it will get settled. So in Indian market, we have only European options. That's how you will see PE and CE. PE means put European, CE means call European. We don't have any American. Again, if you see the nature of American people and European people are more conservative. American people are very not conservative. So that's how the name is European option, American option. Nothing to do with America or Europe. It is the nature. The name is there. So across world, these two names are there: European option and American option.
Yes, sir. Someone is asking, NISM is giving training only in derivatives.
NISM is giving training in all parts: equity, derivatives, investments, then different say market microstructure related like mutual funds, fixed incomes. We have series of training programs. You can go through our website. You will see which are the trainings that are lined up. You can join, and we don't charge much. If you see in the industry, the charges like anything 1 lakh rupees, 80,000 rupees. We don't charge much. So some minimum charges. Yeah.
Yes, sir. One more question. Block deal happening time, sir?
So there is a morning time 8:45 to 8:50 to 9:15. There is a afternoon time 1:50 to 2:15. Exactly, I can't remember that time, but morning session is before pre-open session. It starts, and afternoon session is the 1:50 to 2:15, somewhere around. So there is a block deal window, separate window. So that is just like wholesale market and retail market. If you go to wholesale market and you ask, I want 1 kg potato, wholesaler will not give. But if you go to retail market and you say you want 200 ton potato, retailer will also not able to give. So that's how these two platforms are different. So in
Yes,
block
sir.
deal, it is mostly wholesale, like larger players are there.
Okay, sir. I guess this is the final question. While hedging interest rate for term loan of tenure 15 years, return of investment 8%, loan amount 1200 crores INR. Given the current interest scenario, which one would be cost competitive? Interest rate future or interest option from viewpoint of borrowing of company?
Can you read through again?
Yes, sir. Yes. While hedging interest rate for a term loan of tenure 15 years, ROI 8%, loan amount 1200 crores INR. Given the current interest scenario, which one would be cost competitive? Interest rate future or interest option from the viewpoint of borrowing of a company?
So now if you will see interest rate futures also, it first you see whether liquidity is there or not. In interest rate future, again liquidity is less. So interest rate option will be very good option because if interest rate further comes down, then your risk will also reduce. You may not exercise that option contract, but if you are entering to future contract, you are bound to exercise.
Okay, so we have got one more question. The member would like to know the importance of ITM, OTM, and ATM.
Okay, so this ITM, OTM, and ATM importance is there in terms of settlement. if you go to on the expiry day or the settlement, all the out of the money will expire as it is, like you will not get anything. In the money will have intrinsic value. So there are two value. One is time value and intrinsic value. In the money will have intrinsic value, and at the money is like spot and futures are same. So if you at the expire you are out of the money, then if you are a buyer, all your money is gone. If you are in the money, you have intrinsic value, because time value on the expiry will become 0 because you are on the expiry date.
So a member is asking the difference between arbitrage and hedging.
See, there are two markets. I'll say BSE and NSE. Arbitrage I'll do with the same future. Suppose say I can do with future and spot and future. Suppose say I am doing arbitrage with same future. I am getting at 200 rupees in BSE, and in NSE it is 210 rupees. I'll buy here and sell at NSE. So now we have something called interoperability. I can buy from one exchange and sell in another exchange, like close the position in another exchange. So that 10 rupees will be my arbitrage profit. Like this, I can do with futures and spot or futures and options. That is called arbitrage. I am getting the benefit out of the price differentiation in two markets. That is arbitrage. When it comes to hedging, I am protecting my loss because I have an exposure on that underlying. That's how it is called as hedging. Hedging is more into the risk management, and arbitrage is more into taking opportunities on the price differences.
Thank you. There's a question. Why is there no information available to retail traders regarding bulk or block deal?
Sorry, why it is not available or available?
Yes, it is not available. Why is there no information available to retail
So
traders
say
regarding?
at the end of the day, exchange notifies how much bulk deal or block deal happens. So just like I gave one example, wholesale market and retail market. So that is a separate platform. If you want to participate in the wholesale market, you need to get that license or get that permission from your broker. So again, if you are participating in wholesale market, you can't sell with 1 share, 2 shares. So there is a minimum share of 5 lakh shares or 5 crore of values transaction, minimum one transaction should be there. So that's how that is not accessible to retailers. But whatever transaction happens at the end of the day, you will get to know how much transaction has happened in these windows.
All right, sir. I think that one more question has come. Which is the largest derivative exchange in the world? And I think you've answered this.
NSE is the
NSE,
largest
NSE.
derivative exchange.
Correct. Yes, thank you. So I think that should wrap up all the questions, sir. I will now request CMA Dibyendu Roy, Additional Director and HOD of BFSI, to give us vote of thanks.
Yeah, thank you, Panda sir, for
Thank you, sir.
today's exhaustive session. I think we had just a glimpse of the knowledge reservoir which you are having, and we hope many more sessions we require to understand the nuts and bolts of this derivative trading. It is not a 1 hour, 2 hour session. We require exhaustive knowledge, so that we first can understand that you have mentioned that fin influencers are influencing in such a way that many people are flocking to the market. and losing their hard-earned money. That should not be
Yes.
there. We should understand, we should do our homework, we should know the nitty-gritties, know the risk, and then plunge in. So good
Yeah.
evening to all the participants who have been taken a patient hearing today. In spite of India-Pakistan match, I think they have taken the time off and for this knowledge enhancement session. I think today the BFSI board they have started their this 4-year journey of the first event which was organized today. This pertinent topic of this derivatives, the future of investment, and we are very much happy that this presentation which Pradipta sir has given, we will share in our BFSI portal so that all the
Yeah.
members can take the benefit out of this, and also our recording will be uploaded in our YouTube channel so that the people may. I have seen in the chat line one of the participants told that he needs to again hear it to understand it in a much more better way. So this YouTube channel will upload it so that you can listen to your convenience. And since the presentation was very crisp and Panda sir has answered the queries, all the queries he has answered, whatever queries were asked by the participants, I thank him wholeheartedly. I also thank our this CMA Ashwinji Dalwadi sir, who is our president ICMA, CMA BB Nayak sir, who is our vice president, and CMA Chittaranjan Chakravarty sir, who is our chairman BFSI board, and all the members of the new BFSI constituted new BFSI board for motivating us to organize this pertinent topic for knowledge dissemination. And we also thank our Arup Shankar Bagchi, who is the Senior Director and Secretary of our BFSI board, for always motivating us to organize such events. We also thank our team members, CMA Dr. Aditi Dasgupta, Ms. Payal Banerjee, Ms. Soma Chakravarti, Ms. Indrakshi Bhattacharya, and Sri Shantanu Pradhan for their continuous support for BFSI activities. We also thank our IT department for organizing this event in an online forum without any glitches. Like we had this session very nicely and we had everybody participating in the event. We hope our BFSI department will continue our efforts for this knowledge sharing activities in the coming days. With this, we come to a conclusion. I thank everybody for today's session. Thank you, sir. Thank you, Payal.
Thank you, sir. Thank you, madam. Thank you, sir.
Thank you, sir.
Thank you for the opportunity. So with your permission, I'll leave now, sir.
Yes, sure. Payal, good job done. Thank you.
Thank you, sir.